friends, welcome to the official YouTube channel of AshEka Financial Planners. My name is Sandeep and I'm the founder of AshEka Financial Planners. My endeavor is to bring to you unbiased and simple to understand financial planning advice. And I thank you for watching this video. Before we get into today's topic, I request you to subscribe to this channel and also hit the bell icon. Please also like and share. It's the first week of February. It's the tax season, and of course many of you would be wondering how to save some income tax. And in today's topic I'm going to be talking about 12 different ways in which you can save on income tax, and they are classified under section 80C and section 80D. Now these two sections are sections in the Income Tax Act which let you get some tax deductions, and I'm going to be briefly talking to you about some of them and also my favorite among these. The very first one, of course, is ELSS. ELSS stands for Equity Linked Savings Scheme, and it's a type of a mutual fund where your investments will get you tax exemption to the amount of how much ever you invest in a particular year, you could claim that as a tax deduction in that year. The only catch is the investments will be locked in for a period of 3 years. However, 3-year lock-in period is one of the shortest lock-in periods for tax saving instruments. You will get to know about that further in the video. If you're wondering what kind of mutual funds or which schemes you would want to invest in, I personally recommend Axis Long-Term Equity Fund. I have invested in that, and I have advised many of my friends and customers also to invest in Axis Long-Term Equity Fund. It is a fund that has delivered over 17% since its inception. In the last 10 years, you can have a look at this picture. You can see that the fund has delivered 17.52 returns in the last 10 years, whereas the equity ELSS category, that is all the funds in this category, have delivered about 11.69%. You can also see that this fund is consistently ranked number 1 in that category. So if you would like to invest in Axis Long-Term Equity Fund, it's very simple. You can send me a message or you can drop a comment, and I will be happy to guide you. AshEka Financial Planners is also officially partnered with Axis Long-Term Equity Fund, so we'll be more than happy to help you invest in this ELSS mutual fund. The second tax saving instrument that I'm going to be talking about is also very popular. It's life insurance. And when I say life insurance, it can be term insurance, it can be endowment plans, it can be unit linked insurance plans, ULIPs. Any life insurance will premium payment will get you ATC deduction as well. Quite often during this tax season, we have many of our investors investing some amount of money in tax saving instruments, and one of the most popular ones seems to be life insurance. And they're mostly endowment plans where you pay for a few years and you get your money back with returns, and you also get tax deduction every time you pay a premium. So if you are paying for 5 years, say a premium of 20,000, 30,000 or whatever, every year you can show that as an investment under section 80C and claim a deduction. Moving on to the third item, which is the children's tuition fee. Suppose you have a child who goes to school, and the entire tuition fee you pay for that child can be claimed as a deduction under section 80C. The fourth one is a very popular instrument again called the Public Provident Fund. Quite a few people find it the easiest way. They go to a bank account, they go to a bank and open a PPF account, and the only problem is it's a long-term investment. You need to stay locked in for 15 years, although after 7 years you allowed partial withdrawals based on some rules. But you have to keep paying for 15 years, and after 15 years you can redeem the amount. You can withdraw the amount with all the accumulated interest. Whatever interest you earn in 15 years is also tax exempt, and currently PPF gives you about 7.9% returns, which is not bad, which is a little better than the bank FDs, and is also tax exempt. So you can invest up to a maximum of 1.5 lakhs, which is again the limit under section 80C. Moving on, this is called the employee provident fund. So when your employer is actually deducting provident fund from your salary, whatever that amount that you are shelling out every month as PF can also be shown as a income tax deduction under section 80C. So remember to claim all the PPF amounts that you're paying every month. You're technically not paying, it's deducted from your salary and deposited in your EPF account, and that amount can be claimed as a tax exemption. Moving on to the sixth item. The sixth item is the tax saving FD, which is a 5-year FD. You need to lock in the amount for full 5 years. Say this year you open an FD for 50,000 rupees. You can claim the income tax deduction for this particular year and not for all the 5 years. However, it's not very popular because the interest that you earn at the end of 5 years is taxable at your hands, and therefore when you are getting only about 6 to 7%, which is the current FD rates in banks, not even 7, most of them have almost 6 to 6.5%, and then you have to pay taxes on that. So therefore it's not a very popular option, but still quite a few people do opt for tax saving FDs. The next one on my list is NPS, which is the National Pension System. Government employees have a mandatory contribution that they have to make. The amount is deducted from their salaries. Others can also enter the NPS as general subscribers. Your money is invested in different pension funds managed by different pension fund companies like HDFC Fund or Kotak Fund or SBI, and it's a very long-term commitment, not extremely popular among people because you can withdraw the funds quite late during your retirement. There are some options to withdraw before that, but it's not very liquid. You cannot get your funds out whenever you want, and also you cannot withdraw or redeem the entire corpus. You have to mandatorily invest some amount in an annuity. So the national pension system comes with an additional benefit also. Apart from the 1,50,000 in section 80C, you can invest another 50,000 in NPS over and above the 1.5 lakh, and totally you can save a lot more. Up to 2 lakhs is what you can do. Say you put all the other money in all the other investments, touch 1,50,000, and you can invest another 50,000 for NPS over and above the 1.5 lakhs. Moving on to Sukanya Samruddhi. It's a very good scheme that was launched a few years back. Sukanya Samruddhi Yojana is for the girl child. If you have a daughter who is below 10 years old, you can enter into this scheme. Sukanya Samruddhi gives about 8.5% returns right now. The age of the daughter will have to be less than 10 when she enters the scheme, and the account will be operational until she is 21 years old, until she becomes 21 years. In between, you can withdraw some amount of money for her higher education. It currently gives about 8.5% and is again tax exempt, so it's a very good scheme, similar to PPF but specifically for the girl child. And of course, next on my list is the home loan principal. So say you have a home loan, and whatever principal component of your EMI, which you will get from your bank, of course, the interest certificate, which will show you how much of principal you have repaid and how much of interest you have repaid. The principal component comes under section 80C, so you can claim deductions if you have a home loan. And finally, the 10th item on my list is the Senior Citizen Savings Scheme. Senior citizens are people who are above 60 years old. They can invest in this scheme. Funds will stay invested for 5 years, after which you have an option to increase it once for another 3 years. And the Senior Citizen Savings Scheme currently gives about 8.6% returns, which is fairly good. So all the money that you invest and you take out after 5 years is tax-free. So if you want fixed returns, about 8.6%, it can vary year on year, but it will stay around the 7-8%. Then this is also one of the schemes that senior citizens can put their money in. And there are 2 other tax exemptions that you can avail, which comes under section 80D. The first one, of course, is health insurance. If you get yourself a health insurance policy, then the premiums can be shown as an investment, and it can be claimed as a deduction. You can have a look at the image on the screen. It talks about the limits that you can claim for. If you are an individual and your parents are below 60 years old, then whatever premium you pay for yourself, your spouse, your children, that can be claimed up to 25,000 rupees, and for parents it's also 25,000 rupees. So totally you can claim up to 50,000 if you are below, if you pay premium for you and for your parents who are below 60 years. Similarly, if you and your family are below 60 years old but your parents are senior citizens, then in that case you get exemption up to 25,000 rupees, whereas your parents get deduction up to 50,000 rupees. If both the individual, that is you, your family, that is your spouse, and your parents are above 60 years, all of you are senior citizens, then you can claim 50,000 for yourself and 50,000 for your parents as well, which brings it to about 1 lakh rupees. There is also a preventive health checkup that you can do. The limit is 5,000, which comes within the section 80D limit of your health insurance. So say you pay a health insurance premium of 20,000 and you get a preventive health checkup done for 5,000. So you can claim both of them under the overall limit of 25,000 for yourself. So if you're going for a health checkup, don't forget to keep the bills safely, because you might need them at the time of tax filing. I'm going to end this video with 2 bonus tips. You must have been wondering what these are. The first one is about ELSS. Now, what many people do is, when an ELSS mutual fund that they've invested in, it crosses 3 years, and after that the money can be redeemed at whatever market value it is. So what people usually do is they withdraw or redeem that amount and reinvest that amount in the same mutual fund or in a different ELSS mutual fund. So you're not putting in any new money into the tax saving, but you're redeeming the same money that you've already invested, and it has crossed 3 years. You can put it back and then continue the investment in the same ELSS fund. So that is one way of reducing the amount you're investing to save by using the same existing investments. And the other one that quite often we don't know about is the interest you earn on your savings account can be claimed as a deduction under section 80TTA, but up to a limit of 10,000 rupees. So if you're having accounts where you get obviously interest every quarter, download your statements and total up the amount of interest that you have earned in the year, and you show them while filing your income tax returns, and up to 10,000 rupees can be claimed as a deduction under section 80TTA. Well, we at AshEka Financial Planners, we also help in tax planning and tax filing. So this is a time when most of you would be wondering how to save taxes and how to go about doing it. And I hope this video has thrown some light on that. And if you want further advice or further suggestions, we are more than happy to help you. You can email us at hello@asheka.in. That is HELLO@asheka.in. You can also comment on this video. Very soon we'll be coming up with a phone line that you could call in or message in to get your financial planning queries answered. Well, thank you once again for watching. Please keep coming back, and thank you for subscribing and sharing the good word. I love you all. See you soon.